Imagine you have exactly $50,000 sitting safely in your bank account right now. You are standing at a massive financial crossroads that will literally dictate the entire trajectory of your adult life and define how you spend your weekends for the next 2 decades. Down one path, you use that capital to buy a rental property, you become a landlord, and you get to proudly tell everyone at dinner parties that you are building a real estate empire. Down the other path, you quietly funnel that exact same $50,000 into broad market index funds, you never talk about it, and you go back to watching television on your couch. 20 years later, if you look at the final net worth statements, both of these paths have made you genuinely, undeniably wealthy. But one of these specific paths cost you hundreds of hours of your precious personal time, plunged you into massive amounts of corporate debt, and forced you to deal with catastrophic plumbing emergencies at 2 in the morning. Today, we are going completely under the hood to tear down the legendary debate between real estate and the stock market. We are absolutely not picking a favorite before we look at the facts. We are running the brutal, unfiltered math that the financial gurus conveniently leave out of their expensive online courses. Let us look at 2 completely identical investors to see exactly how this mathematical reality plays out over time. We will call them Alex and David. They are the exact same age, living in the exact same metropolitan city, and earning the exact same comfortable $55,000 salary. They have both managed to aggressively save up $50,000 in cash. The only single variable in this entire equation is what they decide to do with that specific pile of money. Alex decides to go all in on physical real estate. He takes his entire 50 grand and uses it as a strict 20% down payment on a solid $250,000 single-family home in a rapidly developing neighborhood. He locks in a 30-year mortgage at a 7% interest rate, which brings his monthly payment to exactly $1,330. He quickly finds a reliable tenant and locks in a lease agreement for $1,800 a month in rent. On paper, when you subtract the mortgage from the rent, Alex is generating exactly $470 a month in pure, unadulterated cash flow. Alex feels like an absolute financial genius. He drives by his rental property on his way to his day job, looks at the physical structure, and feels the incredible, tangible pride of true physical ownership. David takes a completely different route with his capital. He takes his $50,000 and drops it straight into a low-cost total stock market index fund. He does not take on a single penny of leverage. He has absolutely 0 tenants to manage. He holds no physical keys, and he has absolutely no cool entrepreneurial story to tell his friends at the bar. Instead, he sets up a completely automated system, much like a complex Python automation script running flawlessly in the background, to systematically invest an additional $300 every single month directly from his checking account. He genuinely never thinks about it again. When his coworkers ask him what he is investing in, he simply says index funds, and they immediately change the subject out of sheer boredom. On day 1, David has nothing to show for his money except a digital confirmation email and a brokerage account password. For the first few years, the psychological experience between these 2 specific strategies could not possibly be more different. Alex's investment is highly visible, tangible, and socially impressive. David's investment is invisible, abstract, and incredibly boring. But as we are about to see, that massive difference in how an investment emotionally feels will dictate every single financial decision they make over the next 20 years. By the time year 3 rolls around, the fantasy of passive real estate income slams headfirst into the brutal reality of physical asset management. On paper, Alex has collected nearly $65,000 in gross rent over those 3 years. His mortgage payments consumed about $48,000 of that income, leaving him with roughly $17,000 in gross cash flow. That $17,000 figure is exactly the deceptive number real estate influencers splash across their video thumbnail. But the spreadsheet completely ignores the brutal mechanics of maintaining a physical structure. When you are designing a large-scale housing project, you have to meticulously account for the structural load, the foundation, and the inevitable decay of physical materials over time. Alex is learning this the hard way. He gets hit with massive property taxes totaling $9,000 over 3 years. His insurance premiums consume another $4,500. He is forced to replace a completely rusted water heater for $1,200, and a sudden roof leak destroys another $2,800 of his profit. He also experiences 1 single month of vacancy between tenants, instantly wiping out $1,800 in lost rent, plus the marketing fees. To find a new renter, after paying for all these hidden, unavoidable costs, Alex's actual real-world net cash flow over 3 years is barely $3,000. And that dismal number does not even factor in the massive amount of free, unpaid labor he put into managing the property himself. If you are tired of the financial industry selling you half-truths and you want to finally see the real unvarnished math behind building generational wealth, you absolutely need to hit that subscribe button to Finance with Max right now. We are actively breaking down these complex financial decisions into completely unfiltered truths, and having you in this growing community helps us expose these toxic financial traps to more people who desperately need to hear this reality. While Alex is actively fighting the decay of his rental property, David has not lifted a single physical finger. His automated investments have quietly and relentlessly grown his portfolio. Factoring in his initial $50,000 plus his steady $300 monthly contributions, and assuming a standard historical stock market return of roughly 10%, his portfolio is now sitting at approximately $76,000. He has dealt with 0 emergency phone calls, he has handled 0 plumbing disasters, and he has performed 0 unpaid labor. But this is exactly where we have to be completely honest about real estate's absolute biggest superpower, and that superpower is leverage. David used $50,000 of his own cash to control exactly $50,000 worth of corporate stock. Alex used $50,000 of his own cash to completely control a $250,000 asset. Because of standard market appreciation, Alex's property has grown in total value to roughly $280,000. That means his actual equity has absolutely skyrocketed to over $60,000 in just 3 years. That incredible 5-to-1 leverage is the exact reason why real estate has historically created so many millionaires. It allows you to use the bank's money to act as a massive multiplier on your own initial capital, supercharging your overall net worth on paper. However, that aggressive leverage comes with a massive, terrifying downside that the real estate community aggressively ignores, and that is the catastrophic liquidity trap. If David suddenly faces a massive, unpredictable life emergency and desperately needs $10,000 in cash, by tomorrow morning, he can simply open his smartphone, click a button to sell a tiny fraction of his index funds, and have the cash instantly wired directly to his checking account. Alex absolutely cannot do that. His entire accumulated wealth is permanently trapped inside drywall, concrete foundations, and roofing shingles. He cannot quickly sell a single bathroom or slice off a piece of his kitchen countertop to pay for an emergency medical bill. In order to actually access his hard-earned wealth, Alex either has to go through the grueling, expensive, and incredibly slow process of selling the entire house, or he has to take on even more high-interest debt by borrowing against his own equity through a bank loan. Physical real estate makes you look incredibly wealthy on a balance sheet, but it can leave you dangerously and terrifyingly cash poor in reality when a sudden crisis hits. The second massive hidden factor we are adding to this equation is the devastating opportunity cost of your personal time. The greatest lie ever told in the financial world is that real estate is a purely passive investment. It is absolutely not passive. It is a highly demanding, highly stressful part-time job. Over a 10-year period, Alex spends literally hundreds of hours screening potential tenants, fixing broken appliances, arguing with expensive contractors, and driving back and forth to the property on his weekend. But what if David, who spends exactly 0 minutes managing his automated stock portfolio, used all of those hundreds of free hours to massively increase his own primary earning potential? What if David spent all of that reclaimed time studying aggressively for a massive public personnel selection exam, aiming for a top-tier score of 90+ points to secure a highly lucrative, stable government career? When you factor in the massive monetary value of Alex's surrendered personal time and compare it to the explosive income growth David achieved by investing in his own human capital, Alex's true return on investment completely plummets. Alex is essentially working a grueling second job just to maintain the illusion of his high investment returns. To make sure you never fall victim to the hidden costs of investing and always know exactly how to value your own irreplaceable time, make sure you are subscribed to Finance with Max. I drop these exact mechanical breakdowns regularly so you can build your ultimate financial empire without sacrificing your entire life, your sanity, and your weekends in the process. Let us fast forward the clock all the way to year 20. The final numbers here are going to completely shatter everything you thought you knew about investing. After 2 decades of relentless mortgage payments, market appreciation, and tenant turnover, Alex's rental property is now worth roughly $500,000. His mortgage is almost completely paid off, and his total equity is sitting right around $450,000. He has successfully built massive, undeniable wealth. But David's boring, completely passive stock market portfolio, fueled by the relentless, unstoppable engine of compound interest and his steady $300 monthly contributions, has also grown to approximately $460,000. They are sitting in the exact same financial stratosphere, hovering right around the $500,000 mark. But the way they arrived at that final destination could not be more wildly different. Alex grinded, stressed, sacrificed his weekends, and took on massive amounts of corporate debt to build his wealth. David simply set up an automated system, waited patiently, and let the massive global companies of the world do all the heavy lifting for him while he enjoyed his life. This is where the math gets incredibly interesting, because changing just one single variable tips the scales entirely. If David had simply increased his automated monthly contribution by just $200 extra, bringing it from $300 to $500 a month, his highly liquid stock portfolio would have completely blown past Alex's real estate equity, easily crossing the $600,000 mark. In the stock market, scaling your wealth is as simple and effortless as slightly increasing a digital bank transfer. In the real estate market, scaling your wealth requires you to go out and buy a whole new physical property, take on another massive 30-year mortgage, double your physical workload, and assume double the liability. The friction required to grow a real estate empire is astronomically higher than the friction required to grow an index fund portfolio. But we have to be incredibly fair and look at the dark, terrifying side of the stock market as well. The stock market does not give you massive lucrative tax write-offs for depreciation. You cannot legally deduct the theoretical wear and tear of a digital stock from your income taxes like you can with a physical building. Furthermore, the psychological torture of stock market volatility is absolutely brutal and unrelenting. Watching your liquid life savings drop by 35% during a global economic crisis requires an elite level of emotional discipline that most normal people simply do not possess. In a market crash, people panic. They sell their index funds at the absolute bottom, and they permanently destroy their compounding engine. Real estate forces you to hold on to your asset because selling a house during a panic is far too difficult. That forced illiquidity actually protects emotional real estate investors from their own worst impulses. The absolute honest truth is that neither asset class is inherently or universally better than the other. If you are highly entrepreneurial, if you deeply understand the mechanics of your local housing market, and you are willing to treat real estate exactly like an aggressive, active business, the leveraged returns can absolutely outpace the stock market over time. But if you deeply value your ultimate freedom, if you want complete geographic mobility, zero management stress, and true, pure passive income, then low-cost index funds will silently build you a massive financial fortress while you sleep. The most expensive mistake you can possibly make is picking an investment strategy based on a catchy social media headline without running the actual, unglamorous math for your own specific lifestyle and risk tolerance. You have to actively choose your hard, and you have to choose it wisely. If this brutal, honest breakdown fundamentally changed the way you look at investing and wealth creation, hit that subscribe button to Finance with Max right now. We are going to keep tearing down these financial illusions and exposing the real math together. Stay relentless, trust the numbers, and I will see you in the next one.